10 Best Cashback Credit Cards for 2026, and the ones you should actually have. A quick note before we continue: ads may play during this video. Your support keeps this content free. Now, let's jump in. If you're taking notes right now, you're already ahead of 90% of people who think this is just another card ranking video. What I'm about to show you isn't just a list of 10 cards. It's the strategic selection framework that financial advisors use when they're helping clients build optimized card portfolios, the same methodology that explains why someone earning 3% cashback might actually be getting worse returns than someone earning 2% once you factor in annual fees, spending requirements, and opportunity costs. Here's what you're going to learn in the next 10 minutes. First, I'm going to show you the 3 fundamental card archetypes that every optimized portfolio should include, and why trying to find one perfect card is a strategic mistake. Second, you'll understand how to calculate your effective return rate, not the advertised percentage, but the actual net benefit after fees and tax treatment. Third, I'll walk you through 10 specific card types that represent the best structures currently available in the market, explaining the mathematics behind each one and who actually benefits from using them. And fourth, you'll learn how to build a 3-card portfolio that captures 85% of available cashback value without the complexity of managing 10 different accounts. Let's start with the framework, because understanding card archetypes is what separates strategic selection from random card collecting. Every well-structured portfolio needs 3 types of cards working together. Your foundation card is a no annual fee option that provides a flat rate on everything. This is your default for expenses that don't fit into optimized categories. Your category specialists are cards that offer elevated rates in specific spending areas where you have high volume, and these typically carry annual fees that you only pay when your spending justifies the cost. And if you're self-employed or running a business, you need a dedicated business card to maintain clean separation between business and personal expenses for tax purposes and liability protection. Now let's look at the 10 card types that represent best-in-class options across these archetypes. I'm going to describe these generically so this information stays relevant regardless of which specific issuers are offering these structures, because card features and issuers change, but the strategic principles remain constant. The first card type to consider is the flat 2% cashback on all purchases with no annual fee and no spending caps. The strategic value here isn't that 2% is exceptional. It's the simplicity and consistency. You're earning a guaranteed return on every dollar without tracking categories, without quarterly rotations, and without paying a fee that requires minimum spending to break even. For someone putting $3,000 monthly on this card, that's $720 annually with zero friction. The break-even is instant. Every dollar you earn is pure net benefit. This becomes your baseline, your default card that ensures you're never leaving money on the table. The second card type offers 1.5% on everything with no annual fee, but includes a substantial sign-up bonus, typically $200 or more after you spend just $500 in the first 3 months. That sign-up bonus is a 40% return on your initial $500 spend, which is extraordinary. If you're building your portfolio or need a secondary foundation card for specific purposes like separating certain expense categories, that upfront bonus can deliver more value in 90 days than the ongoing rate delivers over 2 years. This is why sign-up bonuses matter strategically. They front-load value that can justify keeping a card even if the ongoing rate isn't market-leading. The third card type is a rotating category card offering 5% cash back on specific categories that change quarterly. Things like gas stations, grocery stores, wholesale clubs, or streaming services. Up to $1,500 per quarter in those categories. then 1% on everything else. No annual fee. The mathematics here are compelling if you can consistently max out the bonus categories. $1,500 per quarter at 5% is $75 in bonus rewards, or $300 annually just from the rotating categories. The catch is you need to activate the categories each quarter, and you need to have spending that naturally aligns with whatever categories they've chosen. For organized people with predictable spending patterns, this card type can deliver exceptional value with zero cost. The fourth card type offers 3% on dining and entertainment, 3% on streaming services, 3% on groceries, and 1% on everything else. No annual fee, and crucially, these are static categories. No quarterly rotation, no activation required. If dining and groceries represent significant spending for you, this could be your primary category specialist without any complexity overhead. For a household spending $1,000 monthly on groceries and $500 on dining, that's $360 in grocery rewards and $180 in dining rewards. $540 annually with zero cost and zero mental overhead managing category rotations. Now we're moving into premium cards where annual fees enter the equation and the mathematics become more nuanced. The fifth card type offers 4% on dining and entertainment, 4% on groceries at U.S. supermarkets up to $25,000 annually, then 1%, and 3% on gas. Annual fee is typically $95. Here's the critical calculation. You need to earn $95 just to break even, which means you need about $2,400 in bonus category spending to justify the fee versus a no-fee alternative. If you're spending $2,000 monthly on groceries and dining combined, you're earning roughly $960 in annual rewards minus the $95 fee for a net value of $865. Compare that to earning 2% flat on the same spending, which would be $480, and the premium card delivers an incremental $385 in net value, but only if you're consistently hitting those spending levels. The sixth card type is specifically designed for business owners. 2% cash back on all purchases with no category restrictions and no spending caps. Annual fee ranges from $95 to $150 depending on the issuer. The value proposition here isn't just the rate, it's the operational benefits. This card maintains clean separation between business and personal expenses, which is critical for tax documentation and liability protection if you're operating as an LLC or corporation. Business cards often include employee cards with spending controls, enhanced purchase protection, and expense tracking tools that have real value beyond the cashback. And remember, business expenses are tax deductible, which changes the effective economics of the annual fee compared to personal cards. The seventh card type is a premium grocery specialist offering 6% at U.S. supermarkets on up to $6,000 annually, then 1%, 6% on select U.S. streaming services, and 3% on transit and gas. Annual fee is $95. The value proposition is obvious if groceries dominate your spending. $6,000 at 6% is $360 in rewards minus the $95 fee for a net value of $265. But you need to max out that $6,000 threshold consistently, because once you cross it the rate drops to 1% and suddenly you're paying $95 annually for below-market returns. This is the trap with high-rate low-cap cards. They're exceptional value if you hit the cap every year, but poor value if you fall short. The eighth card type offers 5% on travel booked through the issuer's portal, 3% on dining including takeout and delivery, 3% on drugstores, and 1.5% on everything else. No annual fee. The strategic question is whether you're willing to book travel through their portal versus directly with airlines and hotels. If you are, and if travel represents meaningful annual spending, 5% on travel is excellent. 5,000 in annual travel becomes 250 in rewards with zero cost. But if you're not willing to use the portal, or if your travel spending is minimal, this card delivers no incremental value over a basic flat-rate card. The 9th card type is a business category specialist offering 3% back on your top spending category each billing cycle, up to $150,000 per year, then 1% on everything else. No annual fee. For businesses with concentrated spending in areas like advertising, office supplies, or telecom, this can be powerful. 10,000 monthly in a single category is 3,600 in annual rewards with zero cost. But the card's algorithm automatically identifies your top category each month, which means you can't control where you get the bonus rate. For businesses with diverse spending across multiple categories, this creates uncertainty that might not justify the complexity. The 10th card type is a premium business card offering 1.5% on all purchases over $5,000 per month, otherwise 1%. Annual fee ranges from $95 to $150. The value proposition targets businesses with consistently high monthly spending who want simplicity over category optimization. If your business spends $10,000 monthly, that's $1,800 annually in rewards minus the fee, for a net value around $1,650 to $1,700. The question is whether that simplicity premium is worth giving up potentially higher returns from category specialists that might offer 3 to 5% in specific areas where you have spending concentration. Now let's talk about how to actually structure your portfolio using these card types. Because having 10 great options doesn't mean you should carry 10 cards. Multiple cards create problems. You fragment spending across accounts, making cash flow harder to track. You increase total credit exposure, which lenders evaluate when you apply for new credit. And you create decision fatigue on every purchase as you try to optimize every transaction. The strategic approach for most people is a 3-card portfolio. 1 foundation card for baseline spending, 1 category specialist aligned with your highest volume expense category, and potentially a business card if you're self-employed. That structure captures probably 85% of available value with minimal complexity. Adding a 4th or 5th card might generate an incremental $50 to $100 annually. But it also adds mental overhead that has real cognitive cost, even though it's hard to quantify. For business owners specifically, the structure looks slightly different. You need complete separation between business and personal spending, which means at minimum 1 business card and 1 personal card. Ideally, you have 1 business foundation card for general expenses, 1 business category specialist if you have spending concentration in a specific area, and 1 personal card for personal use. That's 3 cards. Maintaining clean separation, optimizing where it matters, and avoiding the complexity of managing accounts across both domains. Let's address credit utilization because this impacts how you should think about credit limits and spending distribution. Your utilization ratio, the percentage of available credit you're using, affects roughly 30% of your credit score. If you're concentrating all spending on 1 card, even paying it off monthly, your utilization at statement close can spike enough to temporarily hurt your score. The solution is either distributing spending across multiple cards to keep individual utilization low, or requesting higher limits on primary cards so normal spending represents a smaller percentage of available credit. For someone spending $5,000 monthly, you want at least $25,000 in total limits to stay under 20% utilization. Ideally $50,000 to stay under 10%. Tax treatment of cashback is something you need to understand, particularly with business cards. Personal cash back on personal expenses is generally treated as a rebate, not income. It's not taxable and you don't report it. Business cash back is more complex. If you're deducting business expenses and receiving cash back, technically you should reduce your deductible expense by the rebate amount because you didn't incur the full cost. You incurred net cost after the rebate. Many small business owners don't do this because IRS guidance isn't crystal clear and amounts seem small. But if you're earning thousands in business cash back annually, this is a conversation to have with your CPA about your specific reporting obligations. Sign-up bonuses deserve special attention because they can dramatically change first-year economics. A card with a $500 sign-up bonus after $4,000 in spending within 3 months delivers a 12.5% return on that initial spending, which is exceptional. But you need to ensure you are going to spend that $4,000 anyway, not creating artificial spending to hit the threshold. If you're accelerating purchases you'd make eventually, that's smart timing optimization. If you're buying things you don't need to capture a bonus, you've turned a financial tool into a behavioral trap that costs money regardless of rewards earned. The opportunity cost of annual fees is something almost nobody calculates properly. When you pay a $300 annual fee for a premium card, you're not just comparing that fee to rewards earned. You're comparing it to what else you could do with $300. If you're in a high tax bracket with access to tax-advantaged retirement accounts, that $300 invested annually at 7% for 20 years becomes about $12,000. So the decision to pay an annual fee is an investment decision that needs to clear your personal hurdle rate, the minimum return you require to justify this use of capital versus alternatives. Before we wrap up, let me summarize the key principles you need to remember when selecting cards. First, structure your portfolio around 3 archetypes: foundation, category specialists, and business if applicable. Not around collecting cards with the highest advertised rates. Second, calculate effective returns after fees, after tax treatment, and after spending thresholds. The stated rate is almost never your actual return. Third, maintain utilization below 20% across all cards to protect your score and preserve access to future credit. Fourth, keep business and personal spending completely separated if you're self-employed to maintain entity protection and simplify tax compliance. Fifth, treat sign-up bonuses as first-year subsidies that can justify cards you might not keep long-term, but only if you're hitting thresholds with organic spending. And sixth, recognize that annual fees have opportunity costs. You're not just comparing fees to rewards, you're comparing this use of capital to your best alternative investment. If you found this breakdown valuable, subscribe to this channel for more strategic financial content that goes beyond surface-level tips. Like this video if it helped clarify how to think about card selection. And drop a comment below with what cards you're currently using or what topics you want me to cover next. I read every comment and use them to guide future videos. This content is for educational purposes only and does not constitute financial, tax, or investment advice. Consult with qualified professionals before making financial decisions.